I want to bring in Stuart Kaiser now. He is UBS head of equity derivatives research. Stuart, we have talked a lot about the expectations around this runoff. And I'm curious how volatility is setting up ahead of it and then beyond it going in, say forward 2 weeks. And Happy New Year, by the way. Thanks for being here.
Happy New Year. Good morning. In terms of volatility, about a week or two ago, the markets were pricing about a 2% move on the election runoff. That's come down to about 1.5%. And I think the reason there is because of the bipartisan stimulus deal that got announced. The runoff was, I think, kind of viewed as the positive, if the Dems win, would be more stimulus, and the negative might be more taxes and regulatory. And now that we've sort of had some of the stimulus get announced, that's taken a little bit of the bite out of the event, as it were. So about a 1.5% move price, which, feels about right, maybe a touch high because, this event has been so well anticipated. But the fact that polls are showing about a 50-50 odds of the outcome is probably why that volatility is where it is. Beyond the election, there's a lot of risk priced into the markets, and frankly, a little bit more than we might have expected, given the type of news flow we got, starting post-election. And I think, the reasons for that are multiple. I think part of it is that there's some scar tissue from last year, really difficult risk year last year. So people are a little hesitant to be short any volatility. And I think the second is the news flow on the vaccine over the last couple of weeks has definitely caught people's attention, starting with Kaiser, maybe not getting as many doses prepared as they had hoped, to the disease mutation, to the slower vaccination pace, and now the full lockdown back in the UK. So I think in our view, the base case outcome has improved over the last couple of months, but the range of outcomes around that hasn't really narrowed that much. And for that reason, the volatility markets are pretty on edge about it.
Stuart, with this return of volatility around the vaccine and then Georgia Senate runoff, what are some of your preferred trades? Have they changed relative to the last week of 2020?
Our view is that risk is probably priced a little bit too high relative to the outlook we have for economic growth, earnings growth, and vaccine rollout. So, generally speaking, we would not be recommending owning a whole lot of options right now, just because the bar is set so very high that for you to, make money owning options right now is tough. The VIX is, 16 or 18 points higher than realized volatility. The level of implied volatility 3, 6, 12 months out is higher than 90% of months that we've seen over the last 80 plus years. So we've generally been of the view that if you're going to hedge, you need to do it in a very cost managed way. One thing we've actually liked is being short S&P 500 put options, longer dated. And, the logic there is just that given our view, that risk is priced very high. So if you were to sell, let's say a 20% out of the money December 2021 S&P put, you generate almost 320 basis points, 3.2% yield, which is extremely high relative to where the dividend yield is and where corporate bond yields are. So, our view is if you're going to hedge, keep it very short dated, focus on the S&P, focus on high yield credit. If you're looking out 6 to 12 months, we think the bar to own those options is very high. And, we'd be either using, lower cost strategies or frankly being short some volatility further out the curve.
All right, you see the opening bell there on this Tuesday morning. Rush Street Interactive ringing the bell. Not a SPAC. We have been tracking just how many SPACs have rang the bell down on the floor in recent days. Stuart, I want to pick up on something else you brought up in your note, which we were all reminded of in March quite abruptly, which is correlations. They all go to 1 in a crisis, and you've noted that they're quite high right now and suggest a more risk-off environment, perhaps, than maybe the popular narrative is suggesting. Certainly, you look at kind of how the market finished last year and what expectations are. What does that say to you about the current setup and maybe skittishness that's out there in the market?
Yeah, I think it says that we're not quite out of the woods. Clearly the news flow on the vaccine has been positive, right? The efficacies are extremely high, and you're already rolling out and vaccinating folks, which is hugely good news. But on the flip side of that, this is an event that people just don't know how to handicap because they haven't been through it before. And the vaccine, the virus mutation, I think, has really caught a lot of people off guard a bit because so many hopes have been pinned towards widespread vaccination and getting to a sort of a herd immunity level. And if this were to mutate in a way that the vaccine was less effective, that becomes a bit of a game changer. And I think the second point is I think most investors hope that these broad-based kind of harsh lockdowns were behind us a bit. And seeing the UK, go back to that type of lockdown, I think does have people really worried about what the economic data is going to look like for the next 1 to 3 months. So I think you're seeing two things. I think you're seeing people worried about the near-term data, and then also at least risk adjusting a bit how bullish they were on the outlook, just because of the degree of uncertainty the virus mutation has brought into the system. And as a result, to your point, that's meant that assets are just moving together. The dollar is moving with equities, is moving with rates, is moving with credit. And that does tend to happen when the markets are quite unsettled and folks aren't, focusing on asset specific fundamentals. So look, it's not the end all and be all for indicators, but I think the fact that volatility is high and correlations are high is telling you that the institutional investment community is still a little bit worried about the pace of things, and they're more than happy to leave just a little bit of extra risk premium in the system until they're proven incorrect.
Stuart, are you seeing investors flock to in the early going here in the new year around any new trades? Maybe some trades or some things that are not being talked about by the market right now, not black swan event type triggered events, but any type of new trades that you're seeing come on people's radar screens?
Yeah, I think one of the things is just the broad-based search for yield at this point. I think last year when you were very, very defensive and sort of hiding under the kitchen table, you weren't as much focused on going out the yield term structure. So I think people are trying to find yield in any way they can. In equities, that would be selling optionality, but also looking at other parts of kind of the credit market. I think the second would be, folks sort of taking a step out the risk spectrum in equities. So I think there's, much more interest in investing in regions outside the U.S., Asia in particular, people also looking around, parts of developing Europe and the emerging markets. So I think now that the calendar's turned and people have a 12-month runway, you're seeing a little bit of a move up the risk curve in those areas as well. So yeah, I think, I'm not saying those are mysterious trades, but I do think people are starting to kind of, dip their toes into some trades that maybe ahead of year end, when they had a surprisingly decent year, they weren't really interested in engaging in.
Certainly, the tone of the overall equity market feels a little bit different here as we start off the year. Stuart, Kaiser, always great to see you. Happy New Year again. UBS Head of Equity Derivatives Research. Thanks.
Thank you.